Hi, in this video, we will learn about return on equities with relevant example and how it can be used. Return on equity is a measure of how efficiently a company is generating profits. Let's understand this using an example. Let's assume an investor is looking to buy shares of a company. The investor has two companies in his list. ABC Corporation, which has generated a profit of 20,000. ABC Corporation has a total of 1000 shares which is worth Rs 50 each. The total value of shares is 50,000. XYZ Corporation has generated a profit of 40,000. XYZ Corporation has a total of 2500 shares which is worth Rs 50 each. The total value of shares is 1,25,000. Let's calculate the RoE for both the companies. Return on equity is a measure of financial performance calculated by dividing the net income with the shareholders' equity. RoE of ABC Corporation will be 20,000 divided by 50,000. RoE of ABC Corporation is 0.4 or 40%. RoE of XYZ Corporation is 40,000 divided by 1,25,000. So, RoE of XYZ Corporation amounts to 0.32 or 32%. Even though numerically XYZ Corporation's profits appear to be bigger, ABC Corporation was able to produce better results with less number of shares to work with. RoE is considered a measure of company's profitability and how efficiently a company is generating profits. The higher the RoE, the better a company is at converting its equity financing into profits. When selecting a company's share, RoE can be one of the useful metrics along with many other parameters in determining whether to purchase the share or not. However, RoE alone cannot be used as a measure to invest in the share. RoE can vary from one sector to another. Hope this video came across as a useful information to you. Thank you for watching.